Oil prices surge and the South Korean markets experience one of the largest ever single-day drops, while the US market continues to coil, acting almost like it's a teenager sleeping in, motionless. We'll look at the impacts of these historic events on the market, review a trade idea, analyze the seasonal impacts of daylight savings time on the S&P 500, and finish up with the fear index for good measure. Let's jump into today's market forecast, starting with the KOSPI. This is the South Korean Composite Index, ticker symbol KOSPI. You could think of this like the S&P 500 of South Korea. And boy, was it catastrophic, being heavily impacted by the price of energy skyrocketing as a result of the Iran war. We've dropped almost 19% in the last 3 days. Now, as this relates to US stocks in the US markets, you're probably going to see this show up most in the semiconductor index. And indeed, we have seen some fall off in the semiconductors with a lot more room to go. One of the things that's concerning here as we look at the semiconductor index is as the semis go, so goes the rest of the market. And it does look like if we start to break through this support line, this could be the beginning of a downturn for the semis, which will likely pull the rest of the S&P 500 with it. We'll come back to the S&P 500 in just a second, but before we do, I want to take a look at the price of oil per barrel. This is ticker symbol BZ1 exclamation mark, or perhaps BZ on your charting software. This is what's known as a future contract, and this is pricing the commodity of Brent oil itself, price per barrel. And we're sitting up here at $82 price per barrel, which is skyrocketing, obviously a result of the war that is going on over in Iran. Now, one of the stocks that is very susceptible to these rising oil prices is Southwest Airlines, ticker symbol LUV. And the reason for this is actually quite ironic and unfortunate. This article in Flying Magazine highlights the fact that Southwest Airlines terminated its multi-year fuel hedging program. There's a whole lot of nerd wrapped up in that, but let's simplify it by explaining it this way. Southwest used options and futures contracts to guarantee what their future price of fuel was going to be. It was a known expense. That guarantee of future pricing came with a cost, and while they were able to get rid of that cost, possibly being a short-term gain, they now are susceptible to changing fuel prices just like you're seeing at the pump, except they use fuel at a much larger rate. Let's take a look at this filing with the SEC. This was not their most recent filing. It was the one back in October 2025. And you can see right here in plain English, fuel contracts. Airline operators are inherently dependent upon energy to operate and therefore are impacted by changes in jet fuel price. Man, was that not prophetic. They come on down here and they say, during the second quarter of 2025, the company terminated the remaining portfolio of fuel hedging contracts. They got rid of their price guarantee. As the price of oil is skyrocketing, so is the price of jet fuel. Now let's look at how that might impact shareholders' opinion on the profits of Southwest Airlines. I asked Claude, the artificial intelligence, to analyze this filing and tell me where the breaking point is on the price of oil as it relates to Southwest Airlines profitability. And it's done some calculations here, and at $80 a barrel, it's estimating jet fuel is going to be $2.40, which represents a $37 million hit for that quarter. At $90 a barrel, the hit goes up to $163 million. And at $100 a barrel, it's estimating that Southwest Airlines is going to have a big problem on its hands at almost $300 million a quarter loss in their profit. That's $1.2 billion a year that they're expecting to lose or not be able to make in profit because they didn't lock in the price of their gas. That's a big oops. Going back to our chart, here's how you can trade this. As the price of Brent oil goes up, I would expect the value of Southwest Airlines to go down. And keep an eye on this chart. Go back to ticker symbol BZ or BZ1 exclamation mark and watch it. And as this continues to creep on up towards $100, I believe you're going to see Southwest Airlines go down. This could be a stock that you consider shorting going forward. From a technical perspective, look how far we have to come back to the 100 period simple moving average as support. This would be a stock that's probably going to do poorly as oil skyrockets. Now let's go back to the S&P 500 and take a look there. You've seen now for several weeks bearish divergence showing up on the S&P 500. We're sitting here at day number 289. But something interesting is happening. We actually plotted a lower high recently. Now, the technical rule is it takes 2 points to make a line, 3 points to make a trend. And we need to see a trend of lower highs while MACD is continuing to make lower highs. And we will say that bearish divergence is over-ish. The indication may be completed, but the fallout, the bearishness of bearish divergence certainly has room to run. And that's going to be playing in nicely with our seasonality concerns that the S&P 500 could turn on down. Secondly, we've got our massive squeeze going on here where the Bollinger Bands are inside the Keltner channel. We're on day 32 of this Bollinger Band squeeze inside the Keltner channel. I'm going to extend this street counter out to 30 days. I pointed this out in the last market forecast. You've got to go all the way on back to 2015 before you've seen a streak that's over 30 days. And this one happened to be 67 days. I thought this was interesting. As you go way on back, they became more frequent as we got before 2008, 2005, 2006. There were several streaks that were over 30 days. And I'll include that indicator in the description below. You can go and analyze each of these time periods. We won't take the time to do that right now. But what you need to understand is the longer the squeeze, profit, yes, please. That means the longer this thing coils up inside this Bollinger Band squeeze, the more likely and the more volatilely it's going to be to break out. We need to keep an eye on that. Now, as we approach daylight savings time, I had a curiosity as to whether there was any impact on the market, seasonally speaking. And I've created an indicator so that you can plot this on your screen as well and study this. But let's bring up our daylight savings time indicator. And here you can see highlighted every time daylight savings time ends in the fall or begins in the spring. This is fully user customizable. You can go in and edit this. I've currently got it set to 30 days by default, the 30 days following daylight savings time or the conclusion of it. But you could set it to a week or 2 months if you want to. But here's the 30 trading days after daylight savings time. And you can see in 2025, the market went down. You can see back in 2024, the market went down. You can see going on back in 2023, this time the market went up. And then prior to that, it went up and down. So you can go back and analyze all of these. I thought it was interesting. The downs tend to outweigh the ups. And while I don't think this is necessarily because of daylight savings time, I do think there is a seasonality component to the stock market. And as we've been watching over many forecasts now, the market tends to go down mid-March going into April. So much so, there's even a saying, sell in May, go away. And I think what this is highlighting is more of a spring seasonality phenomenon than daylight savings time. But it's fun to look at. Let's wrap up today's forecast with the VIX, the fear index, if you will. Chris Burgess did a great video on this a few days ago. If you want to learn more about the VIX, I encourage you to watch that. I'll link that here. But the VIX has been climbing up. It's a little hard to see with the candlesticks, but if we switch over to a line chart, you can see most definitely the VIX has been on the rise. And if you've been watching these market forecasts, you know that as the VIX goes up, the S&P 500 tends to go down. We can plot the S&P on top of this with a new price scale, make them both line charts. And here's the most obvious example. As the S&P 500 is going down, you can see the rising VIX. And as the S&P is going up, the VIX is going down. These are typically inverse to each other. What's the VIX been doing? It's the black line. It's been going up. What is that preparing the market for? the S&P 500 to go down probably. I'll put the link to the daylight savings time indicator and the squeeze indicator in the description. If you would do me a favor in return and comment on this video while you're liking it, that really helps YouTube know that you're enjoying and getting value out of this content. Blessings and favor on your trades. I'll see you in the next market forecast.